What's up, everyone? It's Karthik with MoneyVest. So markets rebounding a little bit on the day. So very much a V-shaped recovery for the markets because we did sell off intraday on some fears related to the consumer, some elevated recession fears once again, the banking sector coming under a lot of pressure here on the day. And we also looked at one indicator that is now coming up to its level that we haven't seen in over 14 years. So the last time we were at these levels was back in 2010. And that is related to corporate bankruptcies. So in the first 8 months in 2024, we have seen as many corporate bankruptcies as we did back in 2010. And that is 452 companies that have filed for bankruptcies. So lots to unpack. Tomorrow is the big day. We've got CPI numbers in less than, 12 hours or something. So we're going to be a little bit over 12 hours. So again, it's about 4:35 p.m. over in New York. So we got lots to unpack. Get ready for tomorrow. It's going to be a big day. Make sure that you drop a like and subscribe to the channel. All I'm asking in return is that you share this video with your friends and family, other traders, investors that can benefit from these videos. So NASDAQ pushing up a little bit over 84 basis points. Like I said, it was selling off a little bit over here. It was down close to 42 basis points and of course recovering very nicely to close almost up about 140 points. S&P 500 up over 1% and the Dow Jones down a little bit over 23 basis points. So a lot of this momentum coming into technology. Let me just pull up my spreadsheet related to the market concentration so we can take a look at the overall gain or losses for both the S&P 500 and of course the Magnificent 7 as well. So while that loads very quickly, I want to go over to the portfolio for the options trading. So I posted this video 12 hours ago, week number 3 in options portfolio. And I currently do have a position opened. I essentially shared this members only private video with everyone. And so far the year to date gain is just over 32% on this portfolio. And the value is sitting at just over $71,000. So again, if you want to get access to these weekly updates as well as these monthly updates that I will be doing for the portfolio for options trading and learn how to actually run the wheel strategy, generate some income while trading options, link's going to be down below. This is just one of the many updates that you can expect, as well as get those trading alerts every single week on options, as well as long-term investing and swing trading as well. So again, link's going to be down below. So markets here, $245 billion gain in the S&P 500. Magnificent 7 was accounting for a little bit over $170 billion for the markets here. Meta platform seems like it was pretty much flat, so we didn't really see any type of gain or loss. Is that actually correct for Meta? Let me just take a quick look here. And Meta platforms, wow. That is actually unbelievable. That is unbelievable because I was kind of freaking out on my spreadsheet that why isn't it loading up? But that is actually correct. Did Meta close at the same exact price as yesterday? I've never seen that ever in my life. I've never seen a stock as big as Meta Platforms, right? So $1 trillion company close at the exact same price as it did yesterday. So $504.79 and $504.79. So literally no change for Meta. And this is like market cap wise, we're going pretty deep. So that is even that is like almost identical to each other. It's crazy. Nvidia going up, closing in at just over $108. This is actually perfect for me because I've got 3 more days left for Nvidia options expiring this Friday, which is also discussed in the options portfolio. And I really need Nvidia. Well, the ideal scenario, I don't really need for Nvidia to trade anywhere, but the ideal scenario for me would be Nvidia trading above 108 but below 110 by the time expiration comes around, which is Friday, September 13th. So I'll keep you guys updated. And of course, I will be doing more videos for members only on the portfolio for options. Coming over to Microsoft, also gaining very well, $63 billion. Apple was very weak, down about $12 billion. And then we did have Tesla pushing up over $31 billion. So all in all, about $170 billion gain in Magnificent 7. Amazon also pushing higher, $42.5 billion on the day. So technology, nice little rebound on the day here. Almost 70% of the gains in the S&P 500 being contributed by Magnificent 7 stocks here on the day. Now, this right here is the chart that I really want to break down. So U.S. bankruptcies year to date hit a 452 bankruptcies, the second highest 8-month total since 2010. So this is breaking news, as 452 large companies have now declared bankruptcies year to date, the second highest number in over 14 years. And this is only below the 466 bankruptcies recorded in 2020. That was for the entire year, I believe, in 2020. So we actually had 466 for the first 8 months and 638 for the entire year. And in August alone, so last month, 63 firms have gone bankrupt, up from 49 in July, marking the fourth worst month in 4 years. And by sector, the greatest number of bankruptcies have occurred in the consumer discretionary sector at 69, and followed by 53 in industrials and 45 in healthcare. For the first time since the pandemic, the economy seems to be slowing down. We expect more volatility ahead. Now, I've put together a list, and before we come back to the daily changes, I've put together a list of what could be like both for and against in terms of a recessionary environment. So I really want everyone to participate in this video, and let's see if we can get a nice discussion going. I really would like everyone to participate and engage in the comment section, and let us know what is your expectation for the economy moving forward, and give us your overview for the next 3 to as many as 6 months for the US. Are we going to go into a recession? If so, are we going to go into a mild or a severe recession? You think there's soft landing possibilities if the Federal Reserve starts cutting interest rates a little too fast, and we kind of avoid a recession altogether? So let us know in the comment section down below. I'll give you the ingredients. You can make the recipe, you can make the dish yourself. But here is the facts. Here are some of the things that you can work with and formulate a plan, and of course your overview, and share that perspective down in the comment section below. I would really appreciate that, and of course it's going to help other members and other people also read your analysis, and of course chime in and share theirs as well. So yield curve inversion. So we had over 700 and plus days of yield curve inverting, which was the spread between the 10-year and the 2-year turning negative. Historically, that has been, not a great sign for the economy, and it's usually when the yield curve uninverts is when the recession actually begins, and we've already seen that as well. So that's been a recession signal when the yield curve starts to uninvert. When it comes to the ISM manufacturing, that's also been contracting below 50, so it's also been really weak, and manufacturing employment has flatlined a little bit. So as I showed you guys in one of my previous videos, with the job openings also in construction specifically collapsing. And these are the two main big sectors, which is construction and manufacturing. This is where we build stuff, whether it's infrastructure, whether it's actual items, goods, products. This is where productivity comes into play. And if these two sectors are flatlining or declining, then that is not a good sign for the economy. It just really is an indication that we are slowing down. Credit card debt is an all-time high, so you can make a case that a lot of people are funding their lifestyle, or the retail sales that we're actually seeing are being funded by credit, by basically debt, and that is not a good sign either. And personal savings rate are at record lows at under 3%. Corporate bankruptcies that I just showed you year to date hitting their highest levels in over 14 years. And JOLS to unemployed persons ratio has now normalized to about 1.07, as I also mentioned in one of our previous videos, talking about how this number was well over 2.5 at one point. It's now normalized as companies are no longer hiring. There's fewer job openings in the economy, and unemployed persons has also been, creeping up slowly and steadily. And the McKelvey and the PMES recession signal also triggered at 0.54, and there's never been any false positives in the past. And this is a combination of both the job vacancies as well as the unemployment rate. They've combined those two numbers, essentially taking into account the 3-month average and subtracting it with the 12-month high and 12-month low, and then figuring out the ratio, which is also at 0.54. Every time we've been above 0.5, there's not been any false positive. A recession has indeed followed. Now, for everyone, who expects recession is not going to happen, there is a possibility for a soft landing. Got something for you as well. So we are still well under 4.5% in terms of unemployment. So low levels of unemployment. Economic growth has been extremely strong, well over 2% for the GDP. There's been low levels of initial claims at under 250,000. Strong retail sales coming in at well over 1%, so there's not been any declines in retail sales altogether. There's also been good corporate balance sheets. However, that kind of contradicts with the corporate bankruptcies. But at the same time, I think this is more geared towards some mid-cap, large-cap companies, and a lot of the corporate bankruptcies might be happening towards the small cap sector, because those are the companies that are struggling the most with their highest funding rate, which we also discussed in our previous videos. And excellent earnings reported also at over 10% year-over-year growth. Companies also reporting some good pricing power and some good earnings also coming in well above expectations from analysts as well. So really want all of you to share your perspective, what you think from the economy, recession or no recession. Comment down below. We'd love to know. And in my opinion, as I've already mentioned, I think there is, at the end of the day, it's really just a coin flip. But I am expecting a mild recession in the US over the next 3 to 6 months, considering a lot of indicators that like these over here are a little bit more of a leading indicator than opposed to these. These can be a bit more lagging indicators. And a lot of this can be sort of dismissed by a simple idea of credit card debt, of just debt in general. And there's a lot of sort of weakness brewing, or at least things are trending in that direction, where these things can eventually also turn sour. So in my opinion, I think the probability for us to see a recession are just slightly higher than us to see a soft landing. But at the end of the day, I just still don't want to make a prediction. I can only share my analysis and my sort of objective overview on the overall economy. And that is that, yes, things are starting to weaken in the economy. Consumers are struggling. A lot of the banks also reported that we're seeing intensified credit conditions in the economy. And as a result, things are not looking super bright if you look out 3 to as much as 6 months out in the economy. So that's where we are. And there's also the conference board that has a U.S. leading indicator metric, right? So what they have really is the LEI. That's a leading economic index for the U.S. And this is as of August 19th, 2024. And you'll notice that they actually take into account a lot of different manufacturing and payroll and unemployment data points, and they kind of combine all that together. And what they have here is that the LEI, so that's the leading economic index's annual growth rate, has stabilized but remains negative, suggesting a downward pressures on the economic activity ahead. So what we have here is just the change in LEI, which is the leading economic indicator, as well as the real GDP. And as we already know, the real GDP, as it turns negative for 2 consecutive quarters, that's when the recession follows. And that's the shaded area over here. That's the shaded areas representing recessions as per the NBER. That's the National Bureau of Economic Research. And of course, as the GDP has contracted significantly, a recession, of course, has followed. And this was, again, a very, very short recession. So this is where the GDP is. I mean, still very positive, still growing at a nice 2.5% clip. However, I also want to point to the idea, by the way, I was pointing to the wrong lines here. So this right here was the recession. So this is the real GDP declining and, of course, coming down to 0. This, again, is going below 0, and this is where we are, stabilizing a little bit. Now, the interesting thing is the blue line, which is the LEI, that's the leading economic index, has actually preceded a real GDP decline, right? So what I mean to say in that sense is that you'll notice that the blue line declines first, and then the black line essentially follows. And that is a very good sort of signal that the leading economic indicator is doing its job really well, that it's actually leading and it's pushing down first, and then the recession follows. In other words, then the GDP starts coming down further. And that's, again, has happened before. In 2007, 2008, then the GDP basically followed. And you'll notice over here a little bit of that preceding sell-off for the leading economic indicator. And then, of course, the economy followed. And what we have seen here is the crossover right about there. And this indicator, once again, turned negative as the GDP continues to trade sideways or basically just flatlining a little bit. So is there going to be a potential pullback here? You know, then a recession, of course, we'll find out very soon. There's been times when, again, they both have come down simultaneously, but since they didn't cross below the 0% line, we didn't really see a recession. However, they're also suggesting for the picture improving now in July as compared to the 6 months leading into July. So things were much worse, earlier in the year and kind of leading into July than where they are now, according to the conference board. And now, since we are sitting well above this sort of line, which is a economic weakness or sort of like a warning signal or a recession signal, since we are trading above that level, they are expecting for a recession to not happen in the future. So for 4th consecutive month, the US LEI, that's a leading economic index, has not signaled a recession ahead because you can see that very, very briefly, like that blue line is just slightly above the warning signal. So if it does cross below that level in August or September, as these readings get updated, I mean, it's possible that we're back down and the real GDP follows, and that's what's happened in the past. So coming back over to this, I really want everyone to, again, take some time, comment down below, what is your expectation for the economy moving forward? Staples, utilities, some of the more defensive sectors continue to do really well. Technology continues to struggle on a year-to-date basis. So this right here is the performance. Utilities up 22%. That's where a lot of money has flown into. Financials, although having a really, really bad week, down over 2%. And on the day, it was down a little bit over, I think, 2% as well. Still up 18.5% year to date. Communication services, 16.5%. Staples up 16.4%. We got S&P 500 up 16%. Healthcare up 14%. QQQ's up 12, almost 13%. And XLK is all the way down here. So that's the technology sector really struggling, up over 10.5% only. This right here, real estate is doing really well, XLRE, although on a year-to-date basis, it is still not the best. I mean, it is up, but it's only up by 12%, so still lagging behind some of the more defensive sectors like utilities and staples, but it has been getting a lot of liquidity. I mean, that chart looks absolutely incredible as XLRE is hitting a new all-time high now. I mean, it's up another 1.7%. You can see the overall performance as it has just absolutely exploded to the upside. And from its lows from back in April of 24, it is up nice 26%. So in the last 3 months, this is up over 15%. Last 1 year, up 22%. So real estate sector continues to see a lot of inflows. Technology led the day today as well, up 1.4%. Then we had discretionaries up 1%, QQQs, healthcare, SPY, utilities, industrial, and some of the losing sectors, financials, because of the jitters over in the banking sector with the net interest income expected to come down. Jamie Dimon also suggesting for stagflation. Goldman CEO suggesting for 10% year-over-year declines in trading and currency trading. So we're seeing that pullback in 1% for financials. And energy, as oil prices continue to get decimated, energy is also down over 1.7. So two of the worst performing sectors were financials and energy. Technology getting a little bit of a rebound as we did see semiconductors, Broadcom, AMD, NVIDIA, SMH, SMCI, Micron, Qualcomm, everything pushing higher, with, of course, Tesla also leading the way in Magnificent 7, up 4.5%. Advanced Micro Devices pushing up, Amazon, Microsoft, NVIDIA, Apple, everything pushing higher on the day. And this right here was the destruction in bank stocks. Ally also suggesting for the intensified credit crunch that they are facing, and the auto loans definitely struggling a bit. Now, coming over to the MoneyVest dashboard, which I know is very, very important, something that all of you guys wait for. 3.57 is where we are with the MoneyVest index. Volatility reading is 19, with VIX percentile at 57%, and back over 60% of the stocks trading above their 50, 200, and as well as 20 simple moving average. Majority of stocks trading back above their 20 simple moving average as well. So we're back in the sort of red/yellow flashing signals here. So again, the risk reward is okay. I mean, the markets are still down 3% from their all-time highs. Believe it or not, I mean, it doesn't feel like the markets are down 3%, does it? It feels like the markets are down more, right? It actually does feel like the markets are down more than 3%. But here we go. That's it. That's it. That's how much we are down from all-time highs. Somebody was asking me the other day, like on Patreon, why am I not buying? Like, why am I not dollar cost averaging? Well, I know that it can feel like the markets are down more than that, but nothing's flashing green right now. Nothing is like, the risk reward is okay. I mean, we're still well within 3% of all-time highs. Just think about that for a second. We're still well within 3% of all-time highs. 3% is practically noise on a week-over-week basis. I mean, S&P, for all we know, could be back to all-time highs in the next week, right? I know there's September seasonality. I know September is one of the worst months. I know that October forms pretty much the bottom, as it has done in the last 4 years, but 3% is nothing. It's not until we get down to a bit of a correction, like we did back in August, is when all these start flashing green, and that's when we start buying. That's when we become more aggressive in the market. But until that happens, I think it's really important to just be patient. I'm running the wheel, right? Because there's a lot of consolidation. There's a lot of sideways trading in the market right now, as opposed to a very directional move to the upside or to the downside. We're really just trading in sort of consolidation pattern here. So a lot of improvement in the technical dashboard. I mean, couple ETFs and asset classes continue to do really well. That is gold and TLT. So that's your commodities and those bonds. Utilities and staples continue to push up new all-time highs. Real estate, as I pointed out, continues to be a big leader, technically speaking. And healthcare and even discretionary is now pushing higher really well. And some of the worst performing sectors, again, you've got technology, communication services, financials struggled on the day. Energy definitely struggling across the board for all their moving averages. We got Russell 2000, and of course S&P NASDAQ still down from their 921.50 SMA standpoint. And then when it comes to Magnificent 7, Google continues to be one of the worst performing stocks down across the board. Microsoft with a little bit of an improvement back above their 5,921 SMA. Meta definitely struggling now on a short-term basis. So is Apple. Nvidia a little bit more on the sideways, trading flat. And Tesla, once again, believe it or not, one of the best performing Magnificent 7 stocks trading across the board above the 5, the 9, the 21, 50, 100, and 200 simple moving average. So doing really, really well. And this right here was the warning from Jamie Dimon. The worst outcome is stagflation. So he says, and I quote, "I would say the worst outcome is stagflation, recession, and higher inflation." Dimon said at a fall conference from the Council of Institute Investors in Brooklyn, New York. And by the way, I wouldn't take it off the table. And as we know that he likes to sound the alarm very, very often. This was another report suggesting for why things could get worse and S&P could hit a low of 4,000 as things get worse. This was from a Sevens report. But all that, again, we're going to ignore a lot of the FUD. We're going to trade the markets that we're in, not the markets that we could be in. We're not going to be making predictions. We're just going to be looking at the risk and the reward. Now, coming over to tomorrow's most important report, and that is CPI. This is all the expectations, all the forecasts from Wall Street banks. And you'll notice that the median forecast is for a 0.17%, and year over year at 2.5. That's for the headline. Core 0.21% and year over year at 3.2. So that is what the median forecast is across the board from all these Wall Street firms. Previous month, of course, we got a 0.15 and a 2.9. So that's going to be a decent reduction of about 40 basis points from the year over year headline CPI. And core is going to expect to be staying flat at 3.2%, slight increase from the previous month as well. So we'll see how the markets react. In my opinion, if you get those numbers, I think that's going to be a huge improvement, although not so much on the core side, but definitely on the headline side, on the back of what I'm assuming to be a big pull down on energy, because core does not include for energy. So it's excluding for energy and food because they're more volatile. And as a result, it's expected to pretty much stay flat. But when you account for that energy deflation, I think that's when the significant reduction is coming into play at 2.5% for headline CPI. But nonetheless, I think that's going to be a pretty strong report overall and could act as a decent catalyst for the markets. We'll be live to cover those numbers. And this is inflation nowcasting. This is from Cleveland Fed. They're expecting 0.2% and 0.26% for CPI and core CPI month over month, and then 2.56. So if you round up a little bit, 2.6, and then 3.2 for core CPI for the month of August. The market's still pricing in for significant rate cuts all the way down to as low as 2.75 and 3%. That's going to be about 200, as much as 240 basis points worth of cuts in the next 12 to as much as 18 months for the market. Now, some more things to focus on. U.S. economy has 1 million full-time jobs lost in a year. All jobs revised down by 818,000, as we discussed in our previous updates. 452 big bankruptcies, $2.1 trillion excess savings. So they're saying big bankruptcies. So I maybe it's not small companies. Maybe it is bigger companies. So we're going to have to take a look at the profile of those companies that are actually filing for bankruptcies, because that is, again, a pretty big deal. And $35.2 trillion in total debt for the economy as well. This is where we are with inflation readings, and coming over to the heat map. Again, mostly green on the technology side, financials, energy struggling. These are some of the price to sales multiple that I also wanted to break down, because you'll notice that, technology continues to trade at price to sales multiple that could be argued at very, very high levels. And that's why it's pushing the S&P 500's price to sales multiple as close to 3, which is also twice as much as the median value of the S&P 500. And some of the more sort of cheaper sectors from a price to sales perspective continue to be energy, financials, healthcare, as defensive staples. Utilities, some of those sectors continue to trade a little bit more cheaply. Now, coming over to volatility, down to 19, a big decent sell-off here from highs of 23 that we saw a couple of days ago. Down a little bit over 19, almost 20%. Still well within that green rectangle. If it does end up, let's say, selling off further, 15 is going to be that next target that we're watching. Keep a close eye on 23 all the way up to as much as 36. Again, the higher the volatility goes, the better the buying opportunities for us. Money Invest Index I discussed in our yesterday's market live stream and of course updates as well. 3.55 is where it is right now. However, this number will get updated by tomorrow as per the spreadsheet. And right now we're kind of like in that neutral zone because the S&P really only is down 3%. So again, we're not seeing a big sell-off. Hence, the Money Invest Index is not super low. I think it's really important to be patient. If there is a bigger sell-off, great, we can buy. If not, mostly invested anyway, so you can take advantage of those longer opportunities and start selling some calls on the way up. Now, coming over to SPX, we are still well within that range on the 30-minute time frame as we have identified. Resistance is going to stay put at 55.65, so that is a level to keep in mind. Support level roughly at 5,400 for the S&P 500 as well. And QQQs had a very nice V-shaped recovery. So, we did see a little bit of a gap up, breakdown, and then of course a recovery back up. And you could argue that we are seeing some nice higher highs and higher lows on a very, very shorter time frame, on a 30-minute time frame, but it doesn't hold as much value as a longer time frame, higher high and higher low. So next target for QQQs is pretty much going to be at 464.50, pretty much call it 465 moving forward, and a support level sitting put at 454 for QQQs. So we really just have a $10 range within which the NASDAQ 100 could be trading going into this CPI print. Now, coming over to individual stocks like Apple first, and Apple here really just consolidating sideways at support, something that we have discussed on the channel before. It's going to be sitting roughly at $217, $218, this level right here, as we have discussed in our previous updates. Resistance all the way up to all-time highs, pretty much at sitting roughly 236 for Apple. Going over Amazon with a nice little bounce up over 2.3%. Resistance all the way up over here. That's going to be sitting roughly at 181 and support level roughly at 173 for Amazon. And if you do get a breakout above this level, next target is going to be all the way up to 189, close to $190 for Amazon. Tesla with a very nice move up, 4.5% to the upside, but we also have a lot of supply sitting for Tesla at those levels, and $233 is going to be that next target. So this right here is going to be that next level to keep in mind for Tesla here. Support level is going to stay up at $208 per share for this company moving forward. Talking a little bit about NVIDIA now. NVIDIA closed perfectly, just over $108, exactly what I wanted. Very oversold though. RSI is coming down, MACD is coming down, so is the L3 Baker oscillator. So, keep a close eye all the way up to as much as $117, $118. I mean, that's a level that it could get up to. However, also keep close eyes on the downside. $96 is where the support is for NVIDIA. That's kind of like a level that we got validated at more recently before pushing back up. And I feel like the reason why it feels like the markets might be down more than just 3% doesn't sound right, is because individual stocks are down way more than that. I mean, NVIDIA, for example, down 22% from its all-time highs. Amazon, for example, is down a little bit over 11% from its all-time highs. You know what? Let me just come over to this. So this will give you a much better idea of where individual stocks are. So take a look at this, and you might be wondering, like, how is it possible? Like, even I'm wondering, like, how is it possible that the S&P is only down 3% from its all-time highs when so many of these Max 7 stocks are trading double digits down from their all-time highs? It's because other sectors have really done well. I mean, they've really pulled weight for the markets to push higher. Utilities, for example, staples, for example, financials, even industrials, healthcare, real estate. I mean, a lot of these sectors are really pulling their weight to keep the markets well within 5% of their all-time highs, even 3% of their all-time highs, while tech continues to struggle. I mean, Amazon down almost 11% from all-time highs in a correction. Apple in a pullback, Netflix in a pullback, Microsoft in a correction, down almost 12% from all-time highs. Google in a bear market. That Google is in a bear market. NVIDIA is in a bear market, right? Down both 22, 23% from all-time highs. Broadcom's down almost 20%. Oracle was just hitting a new all-time high today. Then we have Tesla in a bear market down over 45%. Meta's in a pullback down over 7%. Adobe's in a correction. Qualcomm's in a bear market. Salesforce in a bear market. So tech is in the toilet right now, as you can see. A lot of them, not doing super well compared to where they were just a few months ago. So Amazon resistance 181. That's going to stay put. Coming over to Nvidia, as we already discussed, $96 to as much as 118. Talking a little bit about advanced micro devices. Nice little rally back up. And we're now trading back above 142. So I'll go ahead and turn this level into a support now. And the next target is going to be all the way up to 162 for advanced micro devices. Support level is going to stay put right here, 142 for AMD. Talking a little bit about PayPal now. PayPal definitely struggling. It was down over 72 basis points. So briefly broke down below that support here at $68. Not a surprise considering how overbought it was. It was consolidating sideways. So we're seeing a bit of a pullback for PayPal. And that right there inside this green rectangle is going to remain that support. Resistance and targets back up to $76, $77. Visa, on the other hand, with very nice breakouts to the upside. Very, very incredible run up here for Visa, up over 12%. Next resistance and target's going to stay put at $290 for Visa. Support level staying put at $282 for this company. Coming over to Meta Platforms. And Meta here, again, just slowly and steadily kind of making its way lower. It's gotten rejected a couple times over here at this resistance of 540. Support level is going to stay put at 479, down to as low as 458 for Meta. Netflix, on the other hand, also just consolidating sideways. So not a lot of volume, not a lot of momentum for this stock. Support level is going to stay put down to 661. Down to as low as $616 for Netflix. Very nice, consistent uptrend, though. Higher highs and higher lows. Google, on the other hand, continues to struggle inside this green rectangle. Google might actually be a stock that I end up selling puts on for the next week because it is down over 22%, like I said, from its all-time highs. So well in a bear market at the moment. Almost 23% now inside this green rectangle. And the next support is going to be all the way down to $129, $130 for Google. Finally coming over to Microsoft. Nice little pop back up. And support and the neckline sitting roughly at $399, close to $400 for Microsoft as well. Enphase has also been under a lot of pressure, and so Enphase could also be one of those stocks that I end up selling the put on, looking at $95 to as much as $97, $90 strikes. Very, very oversold right now. As you can see, the RSI MACD has been coming down, and it's pretty much been trading inside this range. I mean, it's been like back and forth here, as you can see, like boom, boom, boom. That's pretty much been the trading behavior of Enphase for a very long time. And then finally, Costco, continues to trade near all-time highs. Support level is going to stay put at $872. Resistance all the way up to $919 per share. So hope you all enjoyed this video and a complete update on the markets. Let me know your thoughts down in the comment section below. The bottom line is technology continues to struggle right now. S&P 500 still well within 3% of its all-time highs on the back of real estate, utilities, staples, defensive sectors, all of them kind of pulling their weight and keeping the markets pretty stable and pretty strong. But tomorrow, CPI numbers, get ready. I'll be live to cover them at 8 a.m. Eastern. Make sure that you drop a like, subscribe to the channel. Link's going to be down below if you want to join, be a part of our MoneyVest community, and of course, get access to all those portfolio updates as well. Happy investing. I'll see you all in the next video.